Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby. Good morning, everyone. It's Quincy Krosby. It's December 5th, Monday morning, and this is The Talking Point. Thank you so much for joining me. I so appreciate it. Well, this morning we are looking at the futures that are in the red. Obviously, we know how this can turn during the course of the day. But I want to go over a couple of features in the market as we begin the week. We are beginning this week with the blackout period for the Fed. Now, I know so many folks say to me, Quincy, can you possibly have a call where we do not talk about the Federal Reserve? You know what? I'm fed up too. There's no doubt about it, but the Fed is important. And it's important because of their path in monetary policy of raising rates. That has an effect on the economy, ultimately. It has an effect on corporate earnings, ultimately. There's a major lag period. And you know, we live in a world where we want immediate answers, the market to show itself immediately. And just as if the Fed was lowering rates, the first aspect in the market, the first phase in the market that would do well would be the interest sensitive sectors. You know, the housing market, for example, mortgage rates would start coming down more quickly than the easing in the rest of the economy because it's a lagged effect. And that's just the way rate hikes and rate cuts work. So it is frustrating, I realize that, but you know, it is what it is. But the good news, here's the good news. It's in the blackout period now. And we will not hear from the Fed again until December 14th. So they meet December 13th and 14th. And on the 14th, we'll get the statement. The market is expecting 50 basis points. That's what the market is expecting. Chairman Powell alluded to it again. Some of his comments last week, by the way, at the Brookings Institute, actually came right out of his commentary at the press conference on November 2nd. And that was the Fed meeting in early November, where he made the comment. He said, look, we are going to be moving to lower rates, stepping down. He said it could come as soon as the next meeting, which happens to be the one in December. And he said, you know, we could go from half a percent to then 1/4% over time. So it's not as if that was new. The thing is that during the interview at the Brookings Institute, which was last week, he made the comment that the Fed wants to assess how the economy is managing with these higher rate hikes, the cumulative effect of the rate hikes, you know, and saying, look, you know, it takes time for these rate hikes to work their way into the broader economy. And so rather than going in again and again with a hawkish stance, we will ease a bit. We'll see how things are going. That's important. The market obviously loved it. But again, we knew that. We knew that from what he said back on November 2nd. That said, as we go into this week, the market is moderately overbought. I'm putting overbought in quotation marks because there are a number of metrics that the technicians used. So I'm not getting into them. I'm just saying it's moderately overbought, meaning typically, and this is important, typically you'll see the market tend to pull back. However, in a true bull market, when a bull market begins and it's kind of ferocious, it doesn't matter that it's overbought. The market will keep going. It will keep going up. So that's important for us to think about as we go into this week. Also, one of the things that I'm paying attention to this week is whether or not before the Fed actually meets again, and we have the press conference on the 14th, can the S&P 500 push above 4,100? That would be the next hurdle. Right now, the S&P 500 sits below that, and it is, you know, it moved above a significant hurdle. Certainly it did, but the next hurdle really is, it is 4,100. So this is something that we want to pay attention to. We want to see if the market could do this before one of the most important data releases will come on December 13th, right? That's not obviously this week, but December 13th, when the Consumer Price Index report comes out again. We'll see if the market can move above that. But it may even before the Fed meets. That's what we're paying attention to. So one of the things that we're looking at this week is, besides data releases, and I'll go over that, happens to be whether or not we could see the S&P 500 shift in psychology, moving from consumer staples, escaping from that with tremendous force, moving into consumer discretionary. That would be significant. Also, I am watching whether or not one of the most important bellwethers for the market and the economy, global economy actually, is the semiconductors. They eked out positive gains last week. Let's see if that can continue this week. That would be telling, it would be significant, and I pay very close attention to the semiconductors. And why? They're in everything. Everything that we do, they are there. And so, I hate to say this because I just don't understand it. Even in these battery-operated toothbrushes, they're there. I don't know what they're telling you. I don't know whether you're looking at pictures in your toothbrush, but they're there too. I know they're in my refrigerator. They're in the stove. And obviously they are in military, missiles, you name it. They are there, and obviously vehicles. They are extremely important bellwether. And again, I'm watching to see if they can climb higher. I'll tell you what I look at. I look at the Philadelphia Semiconductor Index. That's the SOX. So let's see if that can continue to inch higher this week. This week, the market also, you could see how resilient it was, and that's a positive for the market. When last week, when we got the payroll report, we saw that wages went in the opposite direction of what the Fed is looking for. Opposite direction. Wages were up. The payroll report, what was it, 266,000 new jobs. Consensus estimates going in were for 200,000 new jobs. Yeah, that is, how shall I say, a miss, but nonetheless, it wasn't like we got a surprise 500,000 new jobs, which is something we had, early on as the Fed was starting to raise interest rates. But that wage is moving up, and this, again, I want to go over why it is important. Wages are an input cost, just like I'm buying metals for my production. I'm buying electricity for my manufacturing plant. It is an input cost. And what companies try to do, obviously, is to pass along that higher cost onto the end buyer, whether it's a retail consumer, whether it is a business consumer. They try to do that. And that's where you get higher prices, and that is where you get inflation. The Fed obviously wants to break that cycle. Now, he talked about it last week at the Brookings Institute, which was obviously, if you looked at the market, it was an incredibly important speech, and in the questions and answers, because you saw how the market took off as he was answering questions and even in his prepared remarks. The chairman believes that you need to see a balance in the labor market, a balance between supply and demand, so to speak, in the labor market. He was asked by the moderator, well, don't you like the fact that wage earners are earning more? Isn't that a good thing? Now, of course, the moderator is an economist and knows what the answer would be, but I think it was fair to ask that question. And his answer was, at the end of the day, this is Powell's answer, at the end of the day, the wage earner does much better when inflation comes down. He pointed out that lower wage earners, have to deal with higher costs on their credit cards. We know that lower wage earners are using their credit cards for necessities. and they're paying a higher, monthly payment. He said also that, when overall prices come down, that's important for everyone, including just wage earners as opposed to those who have, a yearly wage. So that's his view. You can't have a healthy economy without price stability. And he said we're keeping at it. That's what he said. But he also introduced, and as I mentioned in the Daily Market Update today, he resurrected the term soft or softish landing. He said, I still see that as a possibility. He said, because we do have a resilient economy. And he said it would be great if we can navigate ourselves to the terminal rate. He said, we don't know what that's going to be. His comments were peppered, by the way, with the term uncertainties. It's uncertain. This is uncertain. That's uncertain, which also I think the market in many ways applauded because he was being honest about it, because this is not a science. It is as much an art form. And this is a Fed, after all, that didn't raise rates for the longest time, thinking that, the issues were just about supply chain problems and that it was transitory. So in any event, the market this week is taking a look at a number of important, important events. One of them is China. And the reason this is important is we saw a data release about China that manufacturing demand from China is way, way down, way down. However, and that represents global demand, by the way, but we're also watching Apple actually discussing that they are moving more into production in India, more into production in Vietnam, more into production actually in the United States. The reason is obviously COVID. The reason is, can we be assured that the Chinese authorities, if there is another major outbreak of COVID, are they going to allow for this targeted approach, which they began last week to suggest that they are introducing it. And so that is one, that there are folks who don't have horrible symptoms of COVID, but they are testing positive, but they have special needs. In other words, they are not as able, maybe the elderly, not as able to go to these sites where they are just all COVID folks and they're sent to quarantine camps, which apparently are just brutal and terrible conditions. Pregnant women staying and isolating, in their own privacy, in their own condo. That is a major move for the authorities to come in and say officially that they are going to allow that. Also, testing is not going to be as onerous for the citizenry of China. Part of the reason that they are beginning to limit the amount of tests is that it's very costly. So they're going to do that. The market is waiting for more signs that they are prepared to become more normal about living with COVID. Also, they have mentioned that they want to do more vaccinations, particularly amongst the elderly. And the reason is the elderly have somehow managed not to be vaccinated. They don't trust the vaccines. And so, again, this comes to a broader issue because this could be key for the shift in policy in China. And that is if they can create a vaccine, still claim it's a Chinese, originated vaccine, but use the technology that is used in the West and used here in the United States specifically. We'll see if they can do that because it has been far more effective. Nonetheless, the market, especially the energy market, the oil market, remember OPEC met. OPEC did not come in with additional cuts. They are sticking to the cuts they announced at the last meeting, in which they announced that there would be a cut of 2 million barrels of oil a day coming and will last until the end of 2023. However, They are still monitoring the price outlook. They want to see what happens with the cap on Russian oil and see how that affects demand and see how it affects overall oil prices. Nonetheless, it has helped the oil price, West Texas Intermediate crude, right now at about $82 a barrel. This is fluid because at the same time, the Saudi energy minister has said in a number of interviews that they would be prepared to come in and cut production more in order to balance the market. So remember, the more cuts you have, the more the price goes up because there's less supply. Speaking of supply in the energy market, in the oil market, and we look towards the supply here in the U.S., stockpiles are down. Remember, please, that they're down. And on top of that, the Strategic Petroleum Reserve, the reserve that the Biden administration has been using to bring out more oil in order to push down gasoline prices, that needs to be replenished. And that comes and then takes even more supply out of the ground. So again, we're seeing the oil prices inch higher. When we talk about energy, it is not just about oil, it is about the entire energy complex. So that is important because there are so many sectors and subsectors within that complex. But so much of the move came from the possibility that China truly is beginning, the very beginning to reopen the economy as best they can. This week, we are going to have some important information for the market. And that is that we're going to see today, that's this morning, Eastern Time, about 10 o'clock, we're going to get the Institute for Supply Management, that's ISM, Services Index. The expectations are that this will be above that important line in the sand, which is 50. Below 50 indicates contraction. Above 50 represents expansion. The expectations are that we will add to the expansion just a little bit, but certainly not coming in with a report that shows contraction. So if it comes in below 50 or even 50, it's going to tell the market that the Fed's policies are truly beginning to work and work in slowing down this economy. We will look in the services for new orders and also for the hiring expectations. That's going to be important. That is this morning. Also this morning, we're going to have factory orders. That is for October, and the expectations are that that will climb a bit too. I should point out for the ISM, Institute for Supply Management Services Index, that is for a November reading. Then we are going to have, on Wednesday, consumer credit. This is important because we're watching, how the consumer is doing, how are credit conditions, and so on. And are we seeing an expansion of consumer credit, or are we seeing a pullback in consumer credit? Expectations are that it will inch up just a little bit, but we'll keep our eye on it, and certainly the market is going to focus on it because the consumer is showing signs of resiliency. Granted, much of it has to do with using our credit cards, but nonetheless, as long as the job market remains solid, maybe not stellar, but solid. Remember, the unemployment rate remains at 3.7%, which is full employment. The consumer feels comfortable spending. And then we're going to have, on Friday, the University of Michigan final report on consumer sentiment, but also a very important report on how the U.S. consumer sees inflation in the future. And that is important for the Fed because they don't want us, the consumer, beginning to see inflation rising over a 1 year or 5 year or even 10-year period, because that becomes entrenched, and then we start thinking about, hey, we better buy this now and buy that. It pushes up inflation, actually, because we actually start hoarding, and that's not what the Fed wants to see. Also, when inflation expectations become entrenched, it's harder for the Fed to break that cycle. So that's why it becomes important. And I always try to clarify this, because when we start seeing rates come down, and when the Fed begins to lower interest rates, it takes a long time for the Fed to break the cycle of disinflation, where, don't spend money today because tomorrow it's going to be cheaper. That's another cycle that actually is difficult to break. So in any event, this week, we want to see if the market can gain on the move last week. We want to see whether or not we see those sectors associated with growth, right? Consumer discretionary, semiconductors, for example, climb higher. That would be the equity market underscoring that it sees a shift. And that's very important because, we could say that we have checked off a number of technical moves in the market, but what we want to do is see it confirmed by the equity market. And also, we want to see it confirmed by the Treasury market, and that would be the 2-year Treasury yield if it inches down, because it matches what the Treasury market sees is monetary policy as it views what the Fed is planning on doing. So all of this is important, and whether or not we can have a momentum rally where the S&P 500 can cross that next hurdle, 4,100. This is the blackout period. The Fed isn't speaking, thank goodness, but that means that we're not going to hear the people who are dovish, the people who are hawkish that move the market. I think that's a good thing, but we'll see if the market needs to wait for December 14th when we have the press conference and hear what Powell sees ahead. So a lot for the market to digest actually in a week that doesn't have that much data. But please keep in mind, the Institute for Supply Management, that's the Purchasing Managers Indexes, very important for the market. Have a very good week. Please don't hesitate to get in touch, and we'll be back next week. Thank you so much. This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.